Good morning, ladies and gentlemen, and welcome to the Q2 FY23 Analyst Conference Call of SHOPERSTOP Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Mamta Samat. Thank you, and over to you, Ms. Samat.
Thank you, Michelle. Good morning, and thank you for joining us on the SHOPERSTOP Q2 FY23 earnings conference call. Today we have with us the senior management represented by Mr. Venu Nair, Customer Care Associate, Managing Director and Chief Executive Officer, Mr. Karunakaran Mohanasundaram, Customer Care Associate, Chief Financial Officer, and Mr. Jaiprakash Maheshwari, Customer Care Associate, Vice President, Finance and Accounts. We will begin the call with the opening remarks from the management, after which we will have the forum open for the interactive Q&A session. I must remind you that the discussion in today's earnings call may include certain forward-looking statements and must be viewed, therefore, in conjunction with the risks that the company faces. Please restrict your questions to the quarter and yearly performance and to strategic questions only. Housekeeping questions can be dealt with separately with the IR team. I will now request Mr. Venu Nair for the opening remarks. Over to you, sir.
Thank you, Michelle and Mamta both, and good morning, friends. Thanks for joining us today to discuss the SHOPERSTOP financial results for the second quarter of the financial year 2023. Along with me, I have my colleague Karuna, our CFO, and Jaiprakash, who heads our FP&A lead. I am delighted to share that we achieved the highest ever sales, EBITDA, and PAT for Q2 in the history of SHOPERSTOP. All the KPIs have improved significantly, and I will share these with you over the next few minutes. Before I start in detail, can I just remind you that we have shared our Q2 and first half results in the investor deck and the press release, and I'm sure you would have had a chance to go through the same. Let me now talk on the Q2 performance and the way ahead. For the last 6 quarters, we have been growing consistently. Customer sentiment was strong in the quarter and continues to be so in the Q3 of this year. The wardrobe reboot, followed by the office reboot, is making us to be one of the best destinations in our chosen segment. Our customer footfalls, both offline and online combined, have surged significantly to an overall 40.8 million visits in the quarter that we are talking about, which compares to 25.3 million visits in the corresponding quarter last year. From the time the economy rebounded from the third wave of COVID-19 in Jan 22, I have been saying that we've had a strong momentum, and that is continuing. Sales, gross margin, EBITDA, and profit have witnessed strong growth. Sales grew by 62%, gross margins improved by 180 basis points, driven by an increased share of full-price merchandise, and on EBITDA, we made 75 crores as against 2 crores last year. We also grew versus the pre-period. Our non-GAAP sales grew by 19% and EBITDA grew by 55% versus the pre-COVID period. Our gross margins also improved by 40 basis points. The sales growth has been particularly impressive during the festive period. During the Pujo, our East region, which has the highest impact due to Pujo, grew by 35%. It is pertinent to note that during the quarter, we had closed a few of our stores for refurbishments, which are now open. We could have had sales of another 20 crores and profits thereon if these stores had continued to be trading during that period. However, we do believe that customer experience is critical, and hence we chose to shut the store in full while the refurbishment was on. On some other KPIs, our ATV grew by 8% versus last year, primarily due to the increased demand for premium and lifestyle products. The growth in ATV has now been consistent for 10 quarters. Let me now share some important details on the operational costs. On a like-for-like basis, we have saved 20 crores, but we have also invested in marketing and digital commerce, besides inflation in the existing stores. We also had a one-off expense of rupees 2 crores on the consideration adjustment from Crossword, which we had sold a year back. Specifically on Crossword, we have now received 90% of the amount, and the balance 10% will be received after 2 years, after which 100% of the amount due would have been received. With the strong sales and tight control on costs, we reported an EBITDA of 75 crores in non-GAAP, a growth of 55%, and rupees 155 crores as per the GAAP financials. Our capex investments in new stores and refurbishments are 38 crores. We opened 3 stores, that is 1 department store and 2 beauty stores during the quarter. Our expansion plan is on track. We are currently under fit out in 4 stores, with 2 stores having opened last week, and a further 3 beauty stores where also we are under fit out. As always, our capex has been funded through our internal resources. We reduced our working capital by 18 crores, and our cash from operations remain positive. We continue to be cash surplus or a net negative company. Today's retail landscape is changing rapidly and dramatically, driven by the big shifts that consumers getting far more informed, product choices multiplying rapidly, technological advancements, and public policy liberalization are all contributing to new flows of information, knowledge, and resources. During these change times, customers are looking for multi-choice, multi-product destinations. Our company has been ahead of the curve focusing on Omni, and we are confident that we are well placed to reap the benefits of these investments. From operations, I will now move on to the performance of our strategic pillars. Our first and foremost strategic pillar of First Citizen, which is our loyalty program. Our engagement with our loyal members has been at its highest level. For this quarter, they contributed to 77% of our sales. Our new enrollments have increased by around 2 lakhs during the quarter and cumulatively by 5 lakhs. We have consistently engaged with our First Citizen members. To give a few examples, our 360-degree campaigns with focused content and creatives were extremely successful. Our active base has increased by 300 basis points, and we achieved this by concentrating on activating loyal First Citizen members who had lapsed and had not come to our stores for a while. And last, we introduced gamification for our loyal members, which also has been very successful. Most importantly, we continue to grow the First Citizen Black member base, and this grew during the quarter. To remind you, the average transaction value is over twice that of a normal First Citizen member, and overall they spend 4 times more than our regular First Citizen members. As you are aware, Black Card members have to pay 4,500 rupees to join this program, and we have been witnessing steady and sequential growth ever since it was launched 2 years ago. We held a number of exclusive programs for our Black Card customers, and this has been extremely well received. The feedback from our customers indicated that these programs are hugely successful. and this is something that we intend to continue to do, providing exclusive experiences for our First Citizen Black members that they couldn't get elsewhere. Personal shoppers have also continued to engage with our customers, and this is again a point of difference for SHOPERSTOP. A number of our customers love the experience that they get because of the advice and assistance that they get from our personal shoppers, and this is something that we are continuing to dial down on. Our association with HDFC Bank Credit Card has been progressing, and we added circa 3,000 cards in the first 6 months. Moving to the next strategic pillar of private brands. During the quarter, our private brands recorded its highest ever sales in a quarter at 192 crores. Our private brands grew by 76% over last year. Specifically, our apparel business within private brands grew by 78% and a whopping 64% over pre-COVID numbers. Consistent with the previous quarters, it has been increasing its share. As of now, our private brands constitute to 21% share on apparels and 15% on overall business. The average selling price increased by 25% during the quarter for private brands. Kids continues to grow within private brands and grew by over 93% on last year. To move the journey of converting these private labels to private brands, we have Sania Malhotra as the brand ambassador, and we had 2 campaigns with Sania during the first half of the year. We had Sania fronting Fratini for the first quarter of the year, and in the last quarter, beginning September, Sania has been the brand ambassador for Kashish, and this specific campaign has been extremely well received, with Kashish growing by 170% year on year. Our focus on the Indian wear brand Bandeya in men's has also been very well received by our customers, and it has grown by over 3 times this quarter. Our focus on women's wear and private brand continues, and this category has grown 82% overall. Most importantly, women contribute to the largest share of our total customer base, contributing to 57% now versus 55% last year. This is for SHOPERSTOP as a whole. Moving on to beauty, which is the third strategic pillar, and our sales for beauty for the quarter grew by 45% against last year. During the quarter, we launched 24 brands in our store, bringing the total number of brands that we have brought into the store at 35. On our private brand, Arcelia, we launched 35 new SKUs during the quarter, and in total, we now have 135 new SKUs on a year-to-date basis. The global supply chain issues have continued, though it has improved as well. During the quarter, we opened 3 new beauty doors, and we have another 3 doors that are under fit out. In the last quarter, I had spoken to you about the importance of content in beauty, and we have continued to invest in the team. Beauty content marketing increases brand awareness, differentiates the brand, builds audience relationships, and drives more revenue. Customers rely heavily on different types of content to make buying decisions, research new products, and learn how to use different types of beauty products. It's critical that our brand is there to engage with them throughout the customer journey. We have begun this journey, and this will help us to diversify further in beauty, which is a growing category. This also will be a big point of difference when we launch the SS Beauty app, which I will talk to you about when I talk about omni-channel in the next segment. At this stage, I am extremely glad to announce that as a part of strengthening this strategic pillar of beauty, we have now obtained exclusive rights for retailing and distribution of a few beauty brands from L'Oreal and Clarins. Brands that we will be distributing from L'Oreal will be in the niche fragrance segment Atelier Cologne, in the couture brands Prada, Valentino, Mugler and Viktor and Rolf, and in the premium brands Ralph Lauren and Azzaro. Clarins will have an offering of skincare and makeup. Our objective of venturing and adding distribution within our beauty pillar is threefold: to create and evolve to serve the rapidly growing beauty and personal care market in India, create a better and unique brand proposition to create a win-win for our retailers, have a better brand representation by bringing the best-in-class global practices to India. We expect the sales from L'Oreal to commence from December and from Clarins in Q4 of this fiscal. The SS Beauty stores continue to trade well, and that's something which will continue to grow as we go forward. Moving on to omni-channel, and we achieved our highest ever gross sales through our digital channels. We have been leapfrogging in our digital sales and 9% this quarter. This is significant considering that we had a large base in financial year 22, largely because stores were either closed due to lockdown or partially closed, and hence a larger portion of our sales coming from e-com. However, as mentioned in the last call, we do look at online and offline together now, given that a large portion of our sales offline is influenced by our digital presence. Apart from reaching out to a larger customer base through Amazon, we also served 30% of our digital sales to customers in cities where we are not present through SHOPERSTOP.com. We are also in the test phase of the SS Beauty app, which will augment the SS Beauty stores that we have opened. This will be an app dedicated to beauty, and we are in the test phase, as I mentioned. We expect to go live with this new app later in this quarter. Further, we continue to leverage on the investment that we have made in digital mediums across data lake, analytics, and personalization tools. Using these tools to aid the personas that we have created on First Citizen helps us to target and offer much more focused offerings to our customers in the communication that we have with them. Finally, on expansion, we opened 1 department store and 2 beauty stores during the quarter. The pipeline is very strong. Even as I speak to you today, we opened 2 stores last week, and we expect to open another 4 in the next 6 weeks. There have been delays due to regulatory approvals, which in turn delayed the opening of our stores. We are on track to open 12 stores for this year, and 9 of these will be in Tier 2 cities. In addition to these, we are planning to open the 15 beauty doors that I had committed in the previous call, and again, 3 of these have opened, 4 are under fit-out. In summary, we have grown consistently since the impact of COVID had paused all economic activities 7 quarters back due to the lockdowns. We are extremely focused on execution of the strategy that we had put in place after COVID, and we are pleased with the progress being made. All our KPIs have consistently improved in this period. I am particularly impressed with the growth of our strategic pillars of private brand, beauty, and omni. We expect sales to remain robust and our growth momentum to continue for the remaining half of this fiscal. Even as we speak, the festive sales for Diwali is strong with 4 days to go. With our new partnership, we will evolve and serve and grow rapidly in the beauty and personal care market in India. We are planning to create better and unique brand proposition to create a great experience for our customers in retail, in beauty. In this process, we have better brand representation by bringing in the best-in-class global practices to India and also bringing in a lot more newer brands in beauty to the country. Our private brand has been firing on all cylinders with a current annual run rate of 1,000 crores. We have been investing into this segment, which we will augment and continue to grow. We continue to remain debt-free, which helps us to leverage better. I wish you and your family a very happy Diwali and will open the call to questions now.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sameer Gupta from India Infoline. Please go ahead.
Hi, sir. This is Percy here, Percy Panthaki. My question is, can you give some idea on the competitive intensity, especially to do with the sale days this quarter, and how much was it higher or lower than normally what you see in Q2? And if there's any adjustment to be made between the timing of sale in Q1 and Q2, and if we look at it on a half-year basis, have the sale days been lower than what a typical year would have?
Thank you, Sameer. Thanks for the question. Sorry, Percy. Sorry about that, Percy. In terms of the sale dates, overall, there was a reduction of 10 days in the total number of the sale days, as you call it, or the end of season period. Some of the reduction, I would say 7 days out of the 10 happened in the previous quarter, as in quarter 1, and about 3 days in quarter 2. To be more specific, it went on till the 19th of August in FY20, whereas this year we finished on the 15th of August. So some Q1 was where the impact was more, Q2 it was lower. And overall, the reason, and I think it goes back to what we've been saying about the consumer sentiment being strong, and also because of that, the confidence for brands to focus on new and fresh merchandise, latest fashion, rather than selling out what was left behind from the past. And the one thing we did specifically see was the mix of full price went up even during the end of season sale period, which again is a reflection of the strong consumer sentiment that we have been seeing.
So in context to that, just wanted to understand the EBITDA and the margins. I'm assuming that obviously because the sale period is lower, there's a positive effect on the overall EBITDA of the company. So just wanted to try and see if it is possible to quantify that impact in rupee million terms.
I think specific to the end of season sale period is probably too granular to be covered, but what we did see was a growth of 50 basis points over the pre-COVID period on gross margin. And of course, EBITDA growth was 55%, which not necessarily only due to margin, but specifically I think at the gross margin level, it was a growth of 50 basis points over FY20.
Right, sir. My next question is on margin trajectory over the next, let's say, 3 years. There are two moving parts to this. One is your investments in Omni, etc. So I don't know whether we should be taking a reduction on that for, let's say, a FY25, 26 level, or do you think it would continue at these levels as a percentage of sales? And secondly, apart from that, whatever EBITDA you're clocking, what is the trajectory there, and where do you see these numbers going, and what are the drivers for margin expansion over the next 3 years?
Percy, Karuna here. So normally we don't give any guidance on the margins. Answering your other questions, yes, the margins should improve because we are focusing on private brands, which will improve the overall margins. We are also focusing on beauty, again, which will improve the overall margins. And as you rightly said, Omni, the margin will come down, but we should be able to offset because of a private brand and beauty will have a higher margins. And in terms of a very broad guideline on the EBITDA margins per se, we have been quite consistent in saying that probably for the next 2 to 3 years we will be in high single digits. Like at the end of the third, it will be high single digit, and we should be a low double digit in the fourth year. So that's the consistent guidance we have been giving for some time now.
And the main driver of this expansion, like for example, if I just use this quarter, I know it's not representative of the full year margins, but this quarter you have done 5.9% if I take your non-GAAP numbers. So this moving up to a double digit over 4 or 5 years, apart from product mix change, is there any other driver which will be responsible, or you think that this 400 basis points or whatever number it comes to, product mix change itself is enough to drive that?
No, it will be a combination of a product mix change plus overall productivity gains in our other fixed expenses. A combination of both per se.
Okay. Yeah, that's all from me. Thanks and all the best.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to answer questions from all participants in the conference, please limit your questions to 1 per participant. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Ankit Kedia from Phillip Capital India Private Limited. Please go ahead.
So I have 3 questions. First is, on the ESOP expenses, is this recurring in nature? What is the total quantum of ESOP expenses we should build in for this year and next year? My second question is on the beauty offline distribution, which you have just entered into. It's a very working capital intensive business. How big is the opportunity for you from these brands of, L'Oreal? And going forward, are we in constant touch with other brands to launch more brands in India? And third is, what is the management view on value fashion, given that some of your peers are aggressively entering into the value fashion segment, and are you all considering that?
Hi Ankit. I will answer the ESOP part and we'll take the other 2 questions. On ESOP, we expect a 14 to 15 crore impact this year and more or less same impact next year also, probably slightly lower. So this is the first 2 years. But having said that, Ankit, this is a non-cash item. I mean, there is no cash outflow because of ESOP expense. We are debiting the expense and crediting the reserve ultimately. So I thought I'll just clarify that.
Sure. On the other 2 questions, Ankit, the first one was on beauty distribution, and as I had mentioned, we are starting off with 8 fragrance brands of L'Oreal and also Clarins, which will start in Q4 next year. It is a business which helps us to secure supply, and also given that we are one of the largest retailers of beauty, and these are brands which would be retailing from our own stores, it helps us to actually have a better offering for our customers from our own stores and online channels. We do intend to continue looking at this avenue to bring in more new brands into the country, especially the ones which are focused in the segment that we operate in, which is the premium and lifestyle segment. There are still a number of brands which are not present in the country, and this gives us the opportunity to bring them in both for distribution as well as for retail. So that's something we intend to continue dialing down on. And your third question in terms of the value segment, you are absolutely right. The value segment is a large segment in the country. It is a segment we are not present in specifically, apart from, and given that we are focused on the premium and lifestyle segments. And it's a segment we are continuing to look at and evaluate. And as and when an opportunity arises, this is something that we may want to get into.
So just a follow-up on the beauty, are the margins in the distribution business of beauty would be similar to the company average, or do you think they can be slightly higher given that these are premium brands?
Cumulatively, it would give us the flexibility to have higher margins, which is one of the reasons we are getting into it. Because effectively, we are controlling the entire chain from the time the product comes into the country to when we sell off to the customers. And hence, yes, definitely much better margins.
Sure, that's helpful. Thank you so much.
Thank you. The next question is from the line of Gaurav Jogani from Axis Capital. Please go ahead.
Thank you for the opportunity, sir. So my question is with regards to again the beauty arrangement, offline arrangement with both L'Oreal and Clarins. So sir, if I get it right, in the note you have written that you have rights for both online and offline distribution, and it's exclusive. So does that mean that those brands only you will be able to retail and not the other players?
The rights is exclusive for distribution, and retailing is not exclusive, and we would be supplying to the other retailers for those brands.
So, but in that case, they will have to source it only from you, right, in India? And
that's correct.
Yeah. So in that particular part of the margins where you are distributing to other retailers, so the margins that would be lower than what the company would be making, right, in terms of their retailing?
Yes, for that, yes. But overall, as I said, given that we are also the largest retailers for this, and hence it gives us the opportunity to have more margin that we currently make. I think what is also worth mentioning is that it is a business where we are funding completely from our internal flows, and it has the internal flows are quite strong, as I have already mentioned. Worth also pointing out that the distribution will be in a subsidiary business, which is separate.
Sure. Okay. So just one more clarification on this part. So if you would be able to highlight, what is the current size of this particular business from the existing, the existing vendor who had just given us this license, and what kind of an opportunity can it create for you going ahead?
I think there are a number of new brands we are talking about, so I would not want to get into specifics in terms of the size of that. It's something which we can give you separately. But overall, these are set of brands which are new to the country, and that's the one that we are going after.
Okay. Got it. Thank you, sir. That's all from me.
Thank you. The next question is from the line of Bharat Choda from ICICI Securities Limited. Please go ahead.
Yeah, hi. Congrats on a good set of numbers. My query was regarding this. Currently, we are at around 119% of pre-COVID levels. So how much of that would be driven by a price hike over the pre-COVID levels, and what would be a sustainable SSG expectation going forward?
Thank you, Bharat. Our overall ASP increase has been to the tune of 10%. And these were price increases that we had taken at the beginning of the year. So it's not something which we did during the quarter. It was around when the season began, the previous season, that is Spring Summer 23, launched in February of 23. That is when we had taken the price hike. And the price hikes have been well received. We have not seen a dramatic impact on volumes despite that. And as I said, our overall bill values have continued to grow and have now grown for 10 consecutive quarters, which essentially points to the fact that we have customers putting more items into their basket when they engage with us in the stores or online.
And sir, that SHG that we are expecting going forward on this base?
We don't normally give guidelines, but it should be in the high single digit, mid single digit to high single digits, Bharat.
So just one more thing, like our private label brand share has increased from around 12% to 15% if we compare to pre-COVID level. But actually, if you look at the gross margin, it has not translated into much more of a gross margin. It is like 32.8 compared to 32.4. So what is it like? What is the reason of this not translating into a better gross margin in spite of a higher private label share?
So, Bharat, if you are comparing with this is the pre-COVID, there are two reasons. One, in the pre-COVID, we had a one-time gain on the gross margin, probably by 50 to 60 basis points, specifically in quarter two. Second one, if you remember, our omni-channel, our digital sales was less than 1%. Right now, it's at 5 to 6%. So that, and normally you are aware, the margins in the digital channels are lower than the offline sales. So, and that's a business we are investing to grow right now. So these are the two combinations has impacted the overall increase in the gross margin specifically for this quarter. But
so going ahead, at least if this momentum in private label continues, so we would see an improvement in gross margins. Is that understanding correct?
Absolutely correct, Bharat.
Okay. Thanks for answering my query, sir. Thank you.
Thank you. The next question is from the line of Nihal Jham from Nuvama Institutional Equities. Please go ahead.
Yes, thank you so much and good morning to the management. So a couple of questions from my side. First, on the beauty distribution business, would the distribution infrastructure for you primarily be the stores you operate, or you would be required to invest in separate warehouses across the country?
Good morning, Nihal. For the beauty distribution business, we would be using our existing infrastructure of our warehouses to do it. So we don't expect a significant incremental cost to do that business.
So that is helpful. The second question was that you've broken the store expansion between the T1, T2, and T3 cities, where I think they're looking at 3 stores out of the 12 this year in the Tier 1 cities, and the other 9 being in T2 and T3.
Your voice is not clear, Nihal. Can you just come closer to the mic?
I'm so sorry. Am I audible now?
Yeah, better.
Yes. Sir, I was asking that you've given the bifurcation of the store expansion of the 12 stores, where only 3 are in T1 and the other are in Tier 2 and 3 cities. So going forward, when you're targeting 10 stores each year for the next 2-3 years, would it be fair to assume that majority of them would be in these T2, T3 cities, and you look at getting into more cities going forward?
So Nihal, you're right. The current base and also the current pipeline for stores that would open this year and next year would be in, I would call it Tier 2 cities, probably not as much into Tier 3 yet, but that's obviously an opportunity going forward. At the moment, we are focusing on Tier 2 and even the Tier 1 suburban catchment where we may not be present. I think what's important to underline is we will be where there is an opportunity that exists. Where our customers are and where there is an opportunity, we would be. The splits being higher into Tier 1 suburbs or Tier 2s is because of the fact that we don't have a presence there, and that is where the opportunity is higher. As the economy grows and as cities enlarge, that's where the opportunity presents itself, which we would capitalize on.
Understood. So this last thing I was looking for a data point was that can you give me the offline customer entry? We are clubbing it currently with online and offline. I was just looking for the offline customer entry for this quarter.
Offline customer entry grew by 3%.
So it was around 25 in Q2, so it grew by 3% is what you were saying.
Yeah.
Thank you so much. I wish you all the best.
Thank you.
Thank you. The next question is from the line of Ali Asghar Shakir from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity. Couple of questions. First is on beauty. So I think we have a target to add about 15 stores in this year. I just wanted to understand with this, a tie-up with L'Oreal and, the other, should we expect this target to go up? And probably if not in this year, should we expect the, pace of addition to go up because of this factor? And second is on the private label. So, I understand in the smaller stores, the mix of private label, particularly in the shelves, is far higher, so probably even about 35-40%. So just want to understand, given that now we are opening more smaller stores, how should we look at the private label mix? I understand, we've grown to about 15% now, but should we expect this to go, much more significantly as we add a lot of stores in the smaller, store size?
Thanks, Ali Asghar. On the first one, on beauty, yeah, it's 15 stores that we are targeting for this year, and we are in line to have that. And going forward, again, we've maintained the guidance that it will be 15 to 20 new beauty doors that we would look at, which is what we do target. As the momentum grows on this, we will look to accelerate that, and that's something which I think we would have a better view on in the coming quarters as we get there. What I would like to state is that this is a segment where we see a huge opportunity for ourselves. We are the largest physical retailers online, and with the augmentation of that with our SS Beauty app and the SS Beauty stores, we do expect to continue our growth journey there. The focus will continue to be across growing the real estate that we have, along with acquiring customers online through the SS Beauty app on beauty specifically. Next year onwards, we would also look to add boutique doors. For example, the L'Oreal brands that we have brought in, for at least a few of them, we would have standalone boutique doors for those brands specifically. So that would be addition to what we have already said. So that's on beauty. The second part, your question was on private brands and the mix of private brands. So currently, as you rightly said, it's 15% to our total base or 21% to our overall. We expect this to continue to grow. And again, as you go into tier 2s, some of these brands have greater resonance, and that continues. And we expect the overall share of private brands to go up to between 25 to 30% in the next couple of years.
Understood. This is very helpful. Thank you.
Thank you. The next question is from the line of Varun Singh from IDBI Capital. Please go ahead.
Yeah, thank you very much. So my first question is on the data point that 25% of online customers shop from cities where SHOPERSTOP did not exist. This number is quite encouraging. I just wanted to understand if you can, when you said give more color on what exactly is the products that these customers would have shopped for. I mean, will that be private label products of SHOPERSTOP or branded stuff?
These are from cities where we are not present, and that's very encouraging. It gives us a view of where our future expansion can be, as well as the demand that we can get. On SHOPERSTOP.com, we are a house of brands. We offer everything that we have in our stores. As I have mentioned in the past, as an omni-channel retailer, every single store of ours and today we have 91 stores, 91 department stores, over 100 beauty doors. All of these doors are linked to SHOPERSTOP.com. Hence, consumers and customers across the country are able to buy all of what we retail from anywhere. And hence, it's not just private brands, it would be a combination of everything.
Sure. And second question is, like out of 12 department stores, you mentioned that around 9 stores we will be opening in tier 2 cities. And also looking at the other statement that you made, that our focus is not value fashion, but premium and lifestyle segment. So, sir, on premium and lifestyle segment, why are we not sensing higher opportunity in tier 1 cities, and why only in tier 2 cities?
So I think I need to clarify myself. Firstly, we are skewed towards metros and tier 1s today. And roughly around 65 to 70% of our business comes from tier 1 and metro cities. And this is something which we will continue to grow in. It's the fact that our presence in some of the cities that are growing is not there is what presents us with the opportunity to go into those cities. And hence, I had clarified that we will be where our customers are, whether it's tier 1 or tier 2. So again, while we talked about and I think the tier 2 needs to be understood very clearly, where when we are saying tier 2, it does mean it could be a place like Gwalior, for example, which we are terming it as tier 2, but by a lot of definitions that could also be tier 1. So I'm not wanting to get drawn into that, but essentially these are cities where we are not present, consumer is there, customer is there, opportunity is there, hence we are going. The other part too, also 3 of the stores which we are opening out of the 12, they are actually in Bangalore, Delhi, and Pune. So these are again places where we already have stores, opportunities there, we are going into it. So and I think we should not draw very strong inferences on the tier 1, tier 2. I think important is we are going in where an opportunity is there, where we are not present, and hence creating customers and consumers for ourselves.
So that will be kind of more of a working geography or places where we see relatively less competition, something like that, sir?
These places, it basically, we are a one-stop shop. We are a multi-choice, multi-product retailer, and as consumers are getting exposed to wider choices, we become a great destination because of the fact that as household brands, as a one-stop shop, customers can come to us and make their purchases. So that's the reason we go into these places. Competition would be present, but that's something which we welcome, and it enlarges the market when that happens.
Understood, sir. That's very helpful. Thank you very much, and all the best.
Thank you. The next question is from the line of Disha Seth from Anvil Share and Stock Broking Private Limited. Please go ahead. Ms. Seth, I have unmuted your line. Kindly proceed with your question.
Yeah, sir, I just wanted to check on 2 points.
You're sounding too low. Could you please switch to your handset, please? Kindly proceed with your question.
Hello?
Yep.
Please proceed. Yeah, sorry for the inconvenience. Sir, I just wanted to check that the private brands which we are at 15% of total sales, you mentioned that going forward it will go 25 to 30%. Did I get it right?
Over the next couple of years, that's the aim, that we would want to 25 to 30% of our total apparel business.
Okay, and so that is which is 15% right now, correct?
It's 21, moving that to 25 to 30.
Okay, and secondly, on our same store growth, sir, what is it in this quarter? and what do we aim going forward?
For this particular quarter, on pre-COVID numbers, I mean, against last year, it makes no difference. On pre-COVID numbers, we had a 10% growth.
Okay.
And our aim, as Karuna had clarified earlier, our target is to have mid to high single-digit growth on a quarter-by-quarter basis.
Okay. And so, can you just throw some light on margins for private label and beauty segment, which is higher margin, and what is the difference? If you can quantify, please.
These are confidential information. We don't normally share what are the margins for the private brands. But having said that, it's higher than the brand margins.
Okay. And beauty are higher than private?
No.
Okay. Okay, sir. Yeah. Okay, sir. Thank you. That's it from my side.
Thank you. The next question is from the line of Manjunathan Jogin, a retail investor. Please go ahead. Mr. Jogin, I have unmuted your line. Kindly proceed with your question.
Hello.
Sir, please proceed.
Hello.
Yes, we can hear you.
Can you hear me?
Yeah, we can hear you. Please go on.
Okay. Thanks for receiving my call. Just I would like to know what is the outstanding of loan.
You mean the term loans?
Any kind of loan. Total, how much do we have loan?
The loan is around about 134 crores as on 30th September 2022, Manjunath.
Sorry, can you tell me again?
The loans are 134 crores as on 30th September 2022.
Okay, yeah. Thank you so much. Yeah, that's all.
Thank you. The next question is from the line of Jay Gandhi from HDFC Securities. Please go ahead.
Yeah, hi. Good morning, everyone. Thank you for the opportunity. So I just missed this one. You mentioned the offline customer entry. If you could just repeat that for the quarter.
So offline customer entry was a growth of 3% over pre-COVID numbers. No, it was on pre-COVID numbers.
Okay, so pre-COVID you did around 10.5 million. So 3% of that. And the conversion. Sorry, go on.
No, go on. You go on.
Yeah. So and the conversion ratio typically is that kind of does that hold? Or
so conversion was fairly flat. The absolute number that you give of 10 million, I am not sure. It was much higher. Overall,
okay, so higher.
So overall, the conversion was fairly flat, and the customer entry total growth was 3%.
Right. So if you could just share these details at some point. I mean, I don't think these are very confidential anyway. These numbers. So, I mean, it certainly helps us reconcile to the top line at some point. I mean, it's just a feedback.
Yeah, okay. Fair enough.
And so the other thing I wanted to ask is, what was interesting today is the 19% jump in sales, right? I was trying to connect that to the working capital movement. Now, inventory days, I'm comparing pre-COVID versus the current quarter. So inventory days have kind of broadly grown in line, 21%, slightly higher than the 19% jump in sales. But more worrying was that the payable days have grown at 29%. So it's literally around 1,800 crores. It's a good 400-500 crore jump. So I get that we are net cash surplus right now. But do you worry that at a certain point, maybe in the next 12 to 18 months, we might have to rein this payable days in? and hence effectively at some point again assume debt or perhaps stop growth? Either of the two.
Neither of the two, JP. Sorry, Jay. See, when we classify our inventories, we have consignment stocks, which is what we call as an ROR stocks. And we also classify what is the creditors below that. So predominantly, if our ROR stocks grow, our creditors will also grow up to that level. Except the last month sale, like for example, the September month sale, we pay in the month of October. That could be the only difference. Other than that, our creditors are absolutely in line with the expansion of the business.
Right. So, but in terms of days, it would not change, right? If I compare September to September, pre versus post-COVID, I get that you probably have some payments to make in October, which will not reflect in the balance sheet right now. But even in terms of days or the proportion to sales, that may not necessarily change, right?
Yeah. For our non-ROR business, it will not change. In fact, it will have marginally come down.
Right. So, but unfortunately, I can see that it's kind of inched up, and it's not just a pre versus post-COVID thing. It's actually over the last 3-4 years, our support from creditors has inched up.
So I think let me from a business point of view, Jay, a couple of things which need to be factored in. As I mentioned, our private brand business grew by 47%, and obviously the overall share of private brand has also grown significantly over the pre-COVID numbers, which we already talked about. Further, we are looking at a fairly large growth in this Q3 as well. And apart from the festive season for which we bought inventory, also we have bought it for winter wear, which have already come in, and hence that is reflected. So it is that investment into the future growth which is being reflected as higher inventory, and that's something which we expect it will get neutralized and come down as the quarter progresses. Further, I think what's important to note is that our working capital continues to be negative.
Right. No, that's fair. But great. I'll probably follow up with you at some point just for a more nuanced look at it. So thank you, sir, for this.
No problem.
Thanks, Jay. You can call us anytime. Thank you.
Thank you. There is a follow-up question from the line of Ankit Kedia from Phillip Capital India Private Limited. Please go ahead.
So in the presentation you have mentioned, on the expansion in the industry, there are some innovative deal structuring happening with landlords, and they are increasing stock of grade A malls in top 7 cities. So are you expected to lose market share?
Sorry, there is some background noise. Your question is not very clear.
Sorry, so I was saying in your presentation you have mentioned there are some innovative deal structures with landlords, for the industry, and at the same time there is significant supply of grade A malls in top 7 cities. So with these two, with your over-indexing to tier 2, tier 3 cities incrementally, are you expected to let go of these grade A malls in top 7 cities? And at the same time, how is the deal structuring being done with the landlords currently by you guys and by the industry?
Okay. Firstly, Ankit, we are not looking to let go or not be present in grade A malls, tier 1 cities, metro cities. These are large markets. These are places where we have a very high brand equity, and these are places we would absolutely not just be present but continue to grow. So that's something I want to be absolutely clear, because these are and I think it needs to keep going back to, we are where our customers are, and these are places our customers are. They are significant, and we will always be present. In terms of the deal structuring and what we have been looking at as we get into some of the newer cities, etc., we look for capex support from our landlords, and this is something which has helped us to go faster, because that way our overall outflow gets optimized, and that helps us to go faster in terms of our expansion.
And sir, lately we have seen, Reliance start Centro, which used to be Central. How do you look at the competitive intensity from a departmental store perspective now, given that last 2 years, there were some tailwinds, given that only Lifestyle and you were aggressive in the market. and now with Reliance coming in and, could be signing more properties, how is that playing out in the market now?
I think so far the number of stores of Centro that have opened are quite minimal. So I guess it's a bit early to comment about it. And even otherwise, we, as a rule, as a practice, we don't comment about competition. What we would say is that when you have a larger critical mass in terms of number of retailers, number of players present together, it becomes a destination or it becomes a larger destination for customers to come in, and that's what we would expect to see. And of course, also worth mentioning, I guess, the fact that even today, the size of the market is large compared to the number of or the size of the organized market. And I think the organized retail is still under 30%, and hence the headroom for growth is very, very significant all across.
Sir, but that would also mean that, if there are more people eyeing the same property, the rentals would increase. So are you seeing that in the market now?
I think competition has always been there. Demand for good property will always be there. And so to that extent, we've not seen a dramatic movement per se.
Sure. Thank you.
Thank you. The next question is from the line of Bharat Seth from Quest Investment Advisors Private Limited. Please go ahead.
Hi, thanks for the opportunity. And sir, my question is on this distribution business that we are undertaking for Clarion and L'Oreal. So you said it will be through subsidiary, and we will be using our own existing infrastructure, which is a part of the SHOPERSTOPs. So do SHOPERSTOP will earn some kind of a logistic margin or distribution margin from subsidiary?
See, the distributing company will import the products.
Correct.
SHOPERSTOP and other retailers also. So for the consolidated SHOPERSTOP, there will be an additional margin.
Oh, that only a gross margin will be additional. But in standalone, we will be able to, that will give some kind of operational leverage of our existing infrastructure. Is that fair understanding?
Yes, absolutely right.
Okay, thank you very much. All the best.
Thank you.
Thank you.
Thank you. The next question is from the line of Gaurav Jogani from Axis Capital. Please go ahead.
So just one question with regards to the receivable rights of rupees crores during the quarter. So this will be included both in GAAP and non-GAAP, right?
Yes.
So to that extent, our margins would be better if we adjust for these 5 crores in that sense, because since it's a one-off.
Absolutely right, Gaurav.
Yeah. And sir, can you help us out? What is this regards to,
So this is the receivables we have written off in our digital business. We have to reconcile between on the goods that are returned and then the customer account balance. So that's the one where we have to write off. It's a one-time write-off we had this quarter.
And I think, sir, if I'm not wrong, a couple of quarters back or maybe the similar entry was there, right? Not this, but maybe the quarter prior to this one?
Yes, you are right again. Yeah, that's right.
Yeah, so it's not regarding to that, right? It's a different one.
Absolutely different one, yes.
Okay, sir. Got it. Yeah.
Thank you. Ladies and gentlemen, before we take the next question, a reminder to all the participants. Anyone who wishes to ask a question may press star and 1 on their touch-tone phone. The next question is from the line of Devanshu Bansal from Emkay Global Financial Services. Please go ahead.
Yes, sir, thanks for taking my question. Sir, I just wanted to understand the consumption trends. So we have delivered about 6% CAGR on a 3-year basis, while other formats, footwear, jewelry, other luxury formats are also sort of delivering about high teen CAGR growth. Even this 6% CAGR growth that we have reported is a combination of about 8% growth in ATV. So I presume there is some sort of impact on the footfall or maybe the conversion side. So can you help me understand what is leading to lower traction in the apparel space versus other categories?
So I think when you say the last 3 years, I presume there is an impact of COVID as well, which has caused some of it. So, and the comparisons obviously may not necessarily be completely like for like, because of the fact that we are more heavily skewed into the metros and tier ones, which had a larger impact during COVID. In terms of the other factor which also had an impact was the expansion, or what didn't happen for the period 2010 to 2018, and that definitely had an impact on our growth in the subsequent years. And that is something, as a part of our strategy, which we have corrected, and it's something which we are going aggressively on. Coming back to the categories and within apparel, since you specifically touch upon that, what I would like to highlight is the two largest categories, men's apparel and western women's wear. These were the two categories which had the highest growth that we have seen, not just in the last quarter, but the quarter before that as well. So the franchise for these large categories of ours is very strong, and that's something which we expect to continue to grow.
Right. And can you sort of give us some breakup across regions? So is this growth of about 6% secular across regions, or some of the regions are sort of lagging behind and some are sort of seeing higher growth trends?
Devanshu, I'm not sure about the 6% that you are referring to, where that comes from. So I'm not sure I will be able to...
Top line CAGR on a 3-year basis.
Top line CAGR on a 3-year basis, see what we can do is this quarter, the last quarter. Beyond that, I think again, and the fact that ever since we've come out of COVID, 6 to 7 quarters now, we have seen significant growth every quarter, both sequential and total. However, for the period, almost a year and a half before that, was the COVID impacted years, and I think we can't, because that had multiple variables in there in terms of lockdown, stores being shut, and so on and so forth, and hence the degrowth effectively that had happened during that period.
Right. Yeah, so sir, I just wanted to understand, but other categories have picked up relatively faster, so because of the pent-up demand, etc., or maybe the occasion where they finally sort of happened. So, but the space where we are in has been a bit lagging behind versus the other categories. So my question was from that perspective. So that pent-up element has still not been visible, or do you see there are chances that wardrobe refreshes, etc., can sort of give us that sort of a demand going ahead?
Quarter for the last, pretty much from Q4 of last year, and definitely since then, we have seen very strong demand across all our major categories, across apparel, beauty, watches, sunglasses, I agree that. And all of them we are seeing extremely strong demand. Consumer sentiment is strong and driven by the wardrobe reboot that started off post-COVID, and then the transition and expanded into an office reboot, as we would call it internally.
Right.
I think what consumer sentiment is, there is premiumization that is happening. Also, we postponed weddings, missions, and that's again driving demand up. Also, as we enter into this, maybe enter is not the right word, we are right in the middle of the festive season. This is the first Diwali after 2 years where people are able to come out and celebrate freely, mingle freely, meet up with friends and family, and all of that is driving demand.
Got it, sir. Thanks a lot.
Thank you. Ladies and gentlemen, this would be the last question for today, which is from the line of Shivaji Mehta, an individual investor. Please go ahead.
Hi, thank you for the opportunity. So I had two questions regarding the value fashion that you had just briefly spoken about. Number one, the entry into value fashion, will this be organic or could that be through an acquisition? And number two, would you look at first stabilizing the beauty and the private label segment first before really entering into value fashion? Or can that happen in the near term also? That's all from my side.
So Shivaji, if I can clarify myself, what I had said was that value fashion is a large market and it is something that we would evaluate. We are not entering into value fashion at this point, or that's not, I have not indicated that at any point. So that pretty much, I think, negates or makes the second question redundant.
Right, sir. Thank you. Thank you. That's all from my side.
Thank you. As that was the last question for today, with that we conclude today's conference call. On behalf of SHOPERSTOP Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.
Thank you, and I wish everybody a very happy Diwali.